Right now, almost every trader on your feed is telling you the same thing. Bitcoin's next move depends on the Fed. It depends on ETF inflows. It depends on whatever Michael Saylor tweets this week. Almost nobody is watching the thing that actually matters. Somewhere inside Wall Street's biggest institutions, a market that barely existed 2 years ago has quietly grown into something worth more than $1 billion. And on some blockchains alone, trading volume has already crossed nearly $5 billion in just the first half of this year. And here's the part that should stop you scrolling. This market might end up being one of the strongest, quietest catalysts behind Bitcoin's next decade. Because this was never really about stock tokens. It's about who controls the plumbing of the entire financial system. And once you understand what's actually happening underneath the surface, you are not going to look at Bitcoin or your portfolio the same way again. Quick disclaimer before we go further. This video is for educational and informational purposes only. Nothing here is financial advice. Markets are volatile, crypto is volatile, and you should always do your own research or speak with a licensed advisor before making any investment decision. Now, let's get into it. Welcome back to the Wealth Continuum. If you're new here, this is the channel where we try to see the moves before the headlines catch up. So before anything else, tell me two things in the comments. Where are you watching from right now? And be honest, are you watching this on your lunch break, in bed, at work when you probably shouldn't be? I read almost every comment, so don't be shy. And here's the bigger question I want you sitting with for the next 20 minutes. Do you actually believe that stocks, real stocks, Apple, Tesla, Nvidia, will eventually live entirely on a blockchain? Type yes or no below, because by the end of this video, I think a few of you are going to change your answer. Stay with me until the end, because the last section ties together tokenized stocks, stablecoins, Bitcoin demand, and Wall Street's long game into one single picture. Miss it, and you'll only have half the puzzle. And if this is your first time here, consider subscribing. We break down the financial shifts that don't make the front page yet, but probably will in a year or two. Here's something I've noticed after years of watching markets. Everyone watches price. Almost nobody watches infrastructure. But infrastructure is where the real money gets made, quietly, years before the crowd notices. Think about it. The internet wasn't valuable because people were excited about routers and fiber cables. It became valuable because of what got built on top of it. Amazon Web Services wasn't a headline story for most people, yet it turned into one of the most profitable divisions in Amazon's history. Payment rails, the boring wiring behind Visas and MasterCard quietly made those companies trillion-dollar businesses. Nobody was hyped about the wiring. Everyone got hyped about what the wiring made possible. Right now, something almost identical is happening in crypto. Crypto infrastructure is slowly turning into financial infrastructure, and the clearest example of that shift, happening in real time, is the rise of tokenized stocks. So here's a question worth sitting with. Why would Wall Street, an industry built on decades of legacy systems, custody rules, and slow settlement, suddenly want to rebuild the entire stock market from scratch? Stay with me, because the answer explains almost everything that follows. Let's strip away the jargon for a second, because most explanations of this make it sound more complicated than it is. Take a company like Tesla, Nvidia, or Alphabet. Normally, if you want to own a share, you go through a brokerage, the trade gets matched, and settlement happens through a chain of intermediaries that can take a day or two to fully clear. A tokenized stock skips most of that chain. A regulated custodian holds the real share. Then, a digital token, backed one-to-one by that real share, gets issued on a blockchain. When you buy the token, you're buying exposure to the underlying stock, but the ownership record lives on-chain instead of in a traditional brokerage ledger. What does that actually unlock? Trading that never sleeps. 24 hours a day, 7 days a week. Access for someone sitting in Karachi, Lagos, or Manila who never had a local brokerage account. Settlement that happens in minutes instead of days. The ability to own a tiny fraction of a single share instead of needing the full price. Lower costs, because you're cutting out layers of middlemen. And programmability, meaning these tokens can be plugged directly into other financial products, like collateral for a loan. Now, I'll admit, on paper, this can sound almost boring. Fractional ownership? Faster settlement? Sure, fine. But stay with me because this quietly rewrites the business model of nearly every major player on Wall Street. When settlement stops taking days and starts taking minutes, entire departments built around clearing and custody either shrink or reinvent themselves. That is not a small shift. That is a structural one. So let's talk numbers because they matter here. Coming into this year, tokenized stocks were sitting at a market capitalization of under $1 billion. As of today, the 10th of July, 2026, that figure has pushed past $1 billion, and trading volume tells an even bigger story. On Solana alone, which currently handles more than 95% of all cross-chain tokenized equity trading, volume for tokenized stocks hit roughly $4.9 billion in just the first 6 months of this year. That's a six-fold jump compared to the second half of last year. One single week in the middle of June saw well over $1 billion in tokenized stock trades processed on that chain alone. So why the sudden acceleration? A few forces converged at once. Institutional demand finally showed up in a real way, not just pilot programs. Regulatory clarity improved with new guidance around broker-dealer custody, and formal exemptions opening doors that used to be locked. Stablecoins matured into reliable settlement tools. Custody solutions got safer and more insured. Real-world asset tokenization broadened beyond just stocks into treasuries, commodities, and credit. Major exchanges started plugging directly into this infrastructure instead of treating it as an experiment. And investor confidence, slowly but steadily, started catching up to the technology. Zoom out even further, and the growth looks almost unbelievable. Tokenized equities went from a couple $1 million in mid-2025 to crossing the $900 million mark within a matter of months. And some research groups tracking the sector describe the growth rate as one of the fastest they have ever measured across any financial product category, digital or traditional. Trading volume for tokenized stocks has already surpassed $15 billion cumulatively this year alone, and it's still only July. Comment below if you had genuinely no idea this market had grown this fast. I have a feeling most of you didn't, and that's exactly why almost nobody is talking about it yet. But here's the strange part, the part almost nobody talks about. Bitcoin is not even the biggest direct beneficiary of any of this. Not yet, anyway. So who is? Here's where it gets genuinely interesting, so stay with me on this one because this is the piece most explainers skip entirely. Every tokenized stock trade needs liquidity to move smoothly. And where does that liquidity mostly come from? Stablecoins. Tokens like USDT and USDC have quietly become the grease in the gears of this entire system. But stablecoins don't exist in a vacuum either. To function, they need treasuries backing their reserves. They need banking relationships. They need reliable settlement rails. And they need a blockchain fast and cheap enough to actually move money on at scale without fees eating the trade alive. So here's the question worth pausing on. Which blockchain ends up becoming the dominant settlement layer for all of this activity? And here's where Bitcoin re-enters the picture, even though it's not directly involved in most of these individual trades. As the entire digital asset ecosystem expands, as more capital, more infrastructure, and more institutional trust flows into crypto broadly, Bitcoin benefits as the anchor asset of the space. It's not a direct cause and effect. It's closer to a rising tide. There's another layer to this most people miss entirely. Analysts at one of the largest global banks have projected that stablecoin growth alone could eventually generate demand for around $1 trillion in on-chain treasury bills, and separately, close to $2.6 trillion flowing into tokenized stocks by the end of this decade. Read those numbers again. We are talking about trillions, not billions, and we are still in what most people would call the early innings. You need to understand this before I show you what's next, because this next part is the actual hinge the entire video swings on. Quick check-in, because I want to know if this is actually landing. What's the weather like where you are right now? I ask because I genuinely read these comments while editing, and it helps me picture who's actually watching. Drop it below. Here's a distinction that changes how you should think about this entire trend. Wall Street firms are not necessarily racing to stack Bitcoin on their balance sheets. What they are racing toward is Bitcoin's underlying infrastructure. Custody systems built for digital assets, settlement rails that clear in minutes, tokenization frameworks, collateral systems built on chain, institutional lending markets running on blockchain rails, digital identity verification, compliance tooling that satisfies regulators while still operating at blockchain speed. Why does that distinction matter so much? Because Wall Street, at its core, doesn't move on ideology. It moves on efficiency. Nobody at a major bank cares whether blockchain is cool. They care whether it settles trades faster, cuts costs, and reduces risk. When something does all three, capital follows, regardless of the narrative. And here's the retention hook worth remembering for the rest of this video. This single distinction, efficiency over ideology, quietly dismantles the oldest criticism ever aimed at Bitcoin. The claim that it's just speculation with no real use case gets a lot harder to defend once the very institutions that dismissed it are the ones building the pipes it runs through. Let's connect the dots into a loop, because once you see this pattern, you can't unsee it. More tokenized assets lead to more demand for stablecoins. More stablecoins lead to more blockchain activity overall. More blockchain activity draws in more institutions looking for exposure. More institutions require more secure custody solutions. And a large share of that custody demand touches Bitcoin directly, since it remains the most liquid, most established digital asset. More Bitcoin custody builds more confidence around ETF products. More ETF demand adds legitimacy in the eyes of regulators and traditional investors. And greater legitimacy attracts even more capital, which restarts the entire loop from the top. This isn't a prediction pulled out of thin air. This is a textbook network effect, the same pattern that turned the early internet from a niche academic tool into the backbone of the global economy. But here's what they're not telling you on the finance shows that only talk about daily price candles. This kind of structural flywheel doesn't show up as a single headline. It shows up gradually in trading volume charts, in custody announcements, and regulatory filings that most people scroll straight past. Hit like right now if this flywheel concept just made something click for you, because honestly, this is the single idea I most want people to walk away from this video understanding. Everything else in this script is really just supporting evidence for this one loop. Stay with me, because the next part is crucial. We're about to look at who's actually funding this build-out, and the names might surprise you. Look at who's actually spending money here. BlackRock, Coinbase, Robinhood, NASDAQ. Even the operator behind the New York Stock Exchange has been building venues specifically designed for non-stop, always-on tokenized trading. This is an infrastructure race, a custody race, a wallet race, a settlement race. And these companies are not spending hundreds of millions, sometimes billions, of dollars preparing for a market that stays small forever. You don't build that kind of infrastructure for a niche product. You build it because you expect the market to eventually measure in the trillions, not the billions. In fact, some of the more conservative institutional forecasts already point toward a multi-trillion-dollar tokenized asset market by the end of this decade. So here's the question I want you to actually sit with, not just scroll past. What do these institutions know, or at least strongly suspect, that most retail investors still haven't priced in? This is where it gets really concerning, and I mean that in the most respectful way possible. Executives inside this space have publicly said they believe tokenized stocks alone could eventually unlock a market worth around $5 trillion, once regulatory frameworks fully mature and adoption spreads beyond early institutional players. Separate projections from major banking research desks put the broader tokenized securities market at roughly $5.5 trillion by the year 2030. Sit with that figure for a second. $5.5 trillion. That's not a typo, and it's not hype from some anonymous crypto influencer. That's a projection coming from one of the largest financial institutions on the planet. Subscribe if you want to see how this plays out over the next few years, because I genuinely believe we're watching the early chapter of something most people will only recognize in hindsight. Now let's zoom all the way out, because individually, these trends look like separate stories. Together, they tell a very different one. Artificial intelligence is accelerating how fast markets process information and execute trades. Stablecoins are becoming the default settlement currency for digital transactions globally. Tokenization is pulling real-world assets, stocks, treasuries, real estate, gold, onto programmable ledgers. Digital identity systems are being built to verify who's trading without sacrificing privacy entirely. Cross-border payments are getting faster and cheaper by the month. Central banks in multiple countries are experimenting with their own digital currencies. And sitting underneath almost all of it is Bitcoin, the asset that started this entire shift toward digital borderless value. Picture where this actually leads. Financial markets that are increasingly internet native, always open, always accessible, running continuously instead of stopping at 5 p.m. on a Friday. And if that future actually arrives, if every asset eventually has some digital tokenized representation, here's the question that should genuinely keep you thinking long after this video ends. What becomes the reserve asset underneath that entire system? What does the world trust as the base layer of value when everything else is just a token sitting on top of it? I'm not going to hand you the answer right now. I want you to actually think about it and drop your take in the comments. Here's another angle worth chewing on while you think that over. If tokenization keeps expanding at its current pace, some researchers believe the entire tokenized asset market, stocks, bonds, real estate, commodities, all of it combined, could approach $2 trillion in size before the end of this decade. One of the most influential asset managers in the world has gone even further, suggesting that eventually every stock, every bond, and every fund could end up represented on a single digital ledger. If that actually happens, and I want to stress that's still a big if, then the question of which asset anchors that ledger becomes one of the most important financial questions of our lifetime. Not an exaggeration. Genuinely one of the most important. But here's what they're not telling you plainly enough on mainstream financial media. This shift doesn't require some dramatic overnight announcement to happen. It's already happening, quietly, one custody deal and one regulatory filing at a time. Now, because this channel doesn't do blind hype, let's talk about what could go wrong. Because pretending this is risk-free would be dishonest. Regulation remains genuinely unsettled in large parts of the world, and rules can shift quickly enough to disrupt entire business models overnight. Cybersecurity threats scale right alongside the value flowing through these systems, and bigger markets attract more sophisticated attackers. Liquidity can fragment across dozens of competing chains and platforms instead of consolidating in one place, which can make execution messier than it looks on a chart. Centralization risk is real too, since a handful of custodians and platforms currently control a large share of this infrastructure. Counterparty risk hasn't disappeared just because a token is on chain, since you're still trusting whoever holds the underlying asset. And smart contract bugs, even small ones, have historically led to real, sometimes catastrophic losses. This is where it gets really concerning if you're not paying attention. Massive opportunity almost always travels with real risk attached. Anyone selling you one without mentioning the other isn't giving you the full picture, and honestly, you should be skeptical of any channel, mine included, that only shows you the upside. Comment below with which of these risks concerns you the most personally. I want to know whether it's the regulatory uncertainty, the security angle, or something else entirely, because your answers genuinely shape what we cover in future videos on this channel. And one more thing worth being upfront about. Even with all of this growth, the current size of tokenized stocks is still tiny compared to traditional equity markets, representing less than 1% of the trading volume you'd see on conventional exchanges in a single day. That's not a reason to dismiss the trend. If anything, it's a reason to pay closer attention because markets rarely announce their biggest shifts in advance. They just quietly grow until one day everyone acts like it was obvious all along. So here's how I'd wrap all of this together, and this is genuinely the part I want you to remember most. Stop obsessing purely over Bitcoin's daily price candle. Watch the infrastructure instead. Watch tokenization volume. Watch stablecoin growth. Watch settlement speed improvements. That is where the real capital is quietly flowing right now, months and sometimes years before it shows up in headlines, because capital almost always moves before the story catches up to it. Most investors wait for price to move first, then chase the reaction. Professionals watch the infrastructure quietly being built underneath, long before the crowd notices anything at all. If Wall Street keeps tokenizing equities at anything close to this pace, Bitcoin likely won't just be another asset riding alongside crypto's broader growth. It could end up sitting at the actual foundation of a rebuilt financial system, the base layer everything else settles against. Before we close things out, let's quickly recap the retention hooks I promised you at the start. Because I want this to actually stick, not just play in the background while you scroll something else. Infrastructure moves before headlines. Stablecoins are the quiet liquidity engine behind tokenized markets. Wall Street chases efficiency, not ideology, and that alone dismantles decades of criticism aimed at Bitcoin. And the flywheel connecting all of it, more tokenization, more stablecoins, more institutions, more Bitcoin custody, more legitimacy, more capital, is not speculation. It's a pattern we've already watched play out with the internet, with cloud computing, and with payment rails. So here's my honest final question for you before you go. Knowing everything you just heard, are you watching Bitcoin's price chart the same way you were 20 minutes ago? Or has something actually shifted in how you think about it? If this video actually shifted how you think about Bitcoin, tokenized stocks, or where this entire market is heading, hit like right now. It genuinely helps this channel reach more people who need to see this. Comment below with what surprised you the most. I want to know specifically which part changed your thinking. And if you want more breakdowns like this one, ones that connect dots, most channels never bother connecting, subscribe to the Wealth Continuum because we're just getting started. One last thing before you go. Share this with the one person in your life who still thinks Bitcoin is just a speculative side bet with no real infrastructure behind it. Sometimes the best way to actually understand a shift like this is to explain it to someone else first. Thanks for staying with me today. I'll see you in the next one.